discussing this year. We're last trading day of the year. It's December 30th. We're roughly flat for the day. The market's down 1%. For the year, we are down 71%. The market's down 21%. We're roughly underperforming by 50%. These are rough numbers. The market's still open. So today I want to discuss a preliminary uh, essay that I'm still writing, so I haven't finished it. So this is not a formal discussion. And the essay is basically a review of the year. And the title is I Was on Top When This Shit Meant a Lot. It's a paraphrase from Drake's song. And I use it for the specific reason that I believe the mechanics of the stock market are encompassed in this, which is that sometimes we pay attention to the future and sometimes we don't. And this is the main reason why we lost money this year, because the focus went away from focusing on the future to being obsessed with what's going on right now. So we increased our time preference enormously. We just care about what's happening as we speak, delivery numbers or tweets from Elon Musk and things like that, versus the future. So shit is another word for future. I was on top when this shit meant a lot. Means when the future was important and the future of Tesla is amazing and very promising, then the stock was very high and we were very successful. And we lost 71% this year because that focus changed. I want to discuss what I want to discuss today is sort of like I said, it's a prelude to the essay. The essay is about the mechanics of financial markets. If you want to understand something, it's worth sometimes to think about the engineering of things. So if you want to understand Bitcoin, and this is something I've learned from Safedin Ammous and his Bitcoin standard, just try to understand it from an engineering perspective. Okay, look at the mechanics and then go from there, build up from there. This is what I want to do with the financial markets. This is what I want to do today. Again, it's a prelude to the essay. The essay is going to have a lot more meat around the bone, and some of my thoughts might change during writing. I just started the essay, but this is kind of the outline of, I have a certain outline in mind, and I want to discuss this today and use it also as a review for the year. This is Not Even Wrong podcast. It's December 30th, 2022. This is Krim Telko. For the day, the fund is flat. The market's down 1%. For the year, we are down 71%. The market is down 21%. We're underperforming by 50%. The market's still open. These things could change. I was on top when this shit meant a lot. Why did we lose money this year? In very simple terms, the focus of the market switched from the future to the present. And in order to understand this, I want to talk about the mechanics of the financial markets. In my essay, I go back to the formation of the first stock market, which is the Amsterdam Stock Exchange. And I use a small short story about some merchants that start investing in the Dutch East India Company. And I try to walk through their thinking process, try to, illustrate how they think while investing in the first limited liability joint stock company, which is the Dutch East India Company. And those mechanics are still in practice today. They're more convoluted, it's more complex, but in essence, the mechanics are the same. And the fundamental driving force of investing in a company like the Dutch East India Company is the profits that the company can make and the dividends that the company can pay. This is the fundament. If you have $10 and you buy a share and the share gives you $2 in dividend this year, then you have a 20% dividend yield, or you have a return of 20%, plus you keep the ownership and you have future dividends that could be paid. So you have to think about what's going to be paid today, and you have to think about what's going to be paid tomorrow. These are the fundamental driving forces of an investment. And then you have the concept of the opportunity cost of capital. In other words, you have the question, okay, if I invest in Tesla, well, then I can't invest in something else. And that something else, what is that? And in the times of the Amsterdam Stock Exchange, the something else was the bonds or the debt of the King of Spain or the King of France or England, basically sovereign debt. And by the way, this hasn't changed either. So your alternative investment when it comes to the stock market. So the thought process, should I invest in Tesla or not, is going to be calibrated with two vectors. One is, what is the promise of Tesla? What are the dividends that this company can pay me? In modern terms, we don't just pay dividends, we also do stock buybacks, but that's not, think of it like, how much cash does this company produce, and how much do I have to pay for that cash? And the other is, what's my alternative? What is their yield on, let's say, sovereign debt? And this is the first thing, of course, that happened this year, is that the yield on the sovereign debt, on the US debt, which is the equivalent of the indenture of the French king or the Spanish king back in 1602 when the Amsterdam Stock Exchange was started. So the US debt has gone up from almost 0% to roughly 4%, 3.5%, 4%, depending on the maturity. So you have an alternative now. You can get 4%, or you can invest in Tesla. And some investors chose to sell Tesla shares and buy debt. And the reason they did that is because the debt is relatively lucrative. It's less risky. Why is it less risky? Well, because you can sell it anytime, you have liquidity, and you have less fluctuations in the price. Although even the debt, to be honest, this year was pretty fluctuating, meaning the principal of the debt was pretty fluctuating. So you could then choose to just put your money in cash and put the money in the bank and collect maybe 2%. I don't know what the banks are paying right now. That's another option. So you have alternatives, and that has driven some of the selling. And in the end, the mechanics of the stock market are such that you have sellers and buyers. And when you have more sellers than buyers, the stock goes down. When you have more buyers than sellers, the stock goes up. So this is definitely one of the main driving forces of the loss of Tesla share price this year. It's the change in the stance of the Federal Reserve. And that's something that's been discussed, obviously, extensively in the media. So this is not absolutely new, but I just want to go back again to the basics, to the fundamentals, the first principles of how a stock market works. If you want to invest in the Dutch East India Company, you're going to think about what is the prospect of this company today and what is the future prospect. And in my story, the character, who is a cloth dealer, I think is a silk trader in Amsterdam, he has a view on the silk trade, which is part of the trade. I'm simplifying the Dutch East India Company into a silk company and a spice company. And this person, the investor, my character in the story, he has the ability to predict, or has a good sense for the silk market and relatively good sense for the spice market. So he has the ability to see the prospects that the Dutch East India Company can deliver. And this is really what investing is all about. You think about what is the prospect of the company that you're investing in. Now, it is my thesis that typically per generation, again, this has not changed since Amsterdam 1602, typically every generation gets one or two shots to really become wealthy with an investment in the stock market. The stock market is not a place where you can generate wealth generally. Like everything else in life, it is only going to generate wealth if you take the risk and do the work to find the right place to put your capital. By the way, it's the same with your human capital. If you work for the wrong company, you're not going to become wealthy. And if you work for the right company, you are going to become wealthy. Or if you choose to do the right business, which is for you, if you choose to be a podcaster or do interviews on podcasts and your name is Joe Rogan, well, you chose the right thing because you're very good at it. If you choose to be a fighter and your name is Conor McGregor, well, you chose the right thing to do, and so on and so forth. I think you're getting my point, that it's not like we can diversify our capital financially, nor human capital, nor any kind of capital. It's really, we have to be concentrated because there's only few opportunities to generate wealth, and that goes back to 0 to 1 and Liftoff and The Soul of a Machine and books like that that explain the compulsory narrative or the character of entrepreneurs. They don't have a choice. They have to do this. But whatever they do is really only a very narrow thing they can do. People can't be very broad in what they do. Even Elon Musk, although he has a lot of businesses, the fundamental task that he's putting himself to solve is always very similar. It's solving certain very difficult engineering problems. He's very good at that, and he's very good at galvanizing engineers to help him solve those problems. That's what he's good at, and therefore he then diversifies his business. But the general thesis is always the same within the context of solving very difficult engineering problems. And let's get back to my Amsterdam story. So the fundamental building block of investing in a productive asset is the prospects of the asset. And this is very important. There's a lot more complexity here because of the opportunity cost of capital, which is important. And that's part of the reason why our Keynesian world, which is the world that we live in since World War I, is so convoluted, because we're not sure about the opportunity cost of capital. The opportunity cost of capital is defined by the debt of the sovereign, and the debt of the sovereign is convoluted with the ability of the sovereign to print money, and therefore we have this constant fluctuation, and it's relatively difficult to assess the opportunity cost of capital. If you were in an Austrian economy where money is, let's say, gold or Bitcoin, and the debt is defined as, you lend out the Bitcoin, but the Bitcoin appreciates, so therefore probably the interest rate will be close to zero. In an Austrian economy, theoretically, the interest rate should be zero because you're already compensated for holding, let's say, Bitcoin or gold, which will appreciate, and therefore you don't need to also charge interest. But nevertheless, it's fairly sure that interest rate will be very low because there's no inflation. So all you have is credit risk, and of course that is subject to market, but the risk-free rate will be relatively low, and therefore you could then focus on the actual prospects of the company. That's my point here. So the very important, there's a part in my story in my essay where I talk about the accountant of my character comes to him and says, why are you still holding on to the Dutch East India Company shares? They give you a 2% dividend yield this year when you can buy 4% indenture of the French king. And the answer is, I'm not going to give that bastard money. And by the way, the 2% dividend yield could go up because I expect higher dividends to be paid in the future. So this is only 1 year, and I could get 3, 4, 5% dividend yields going forward. So accumulated, I get more dividend yield than if I give the money to the French king. On top of that, I hate the guy, and so on and so forth. It's a very similar conversation that we're having today, where we might say, well, we want to give the money to the government, but why should we give the money to the government? The government is only wasting money. Shouldn't we give the money to a productive asset? Well, the answer to that is that you don't really have a choice here, because if the government decides to crowd out private investors, they have that power. And this is part of the value proposition of Bitcoin, that we want to take that power away from the government. But again, that's for another podcast. Let's stick with the mechanics of financial markets. So one of the big issues with financial markets, to summarize this part of the essay and this episode, is the opportunity cost of capital, which is part of the problem. Because it fluctuates, it makes it a little bit more difficult to invest. But if we just look at what happened this year, and the explanation for our dismal year is that, again, we were on top when the shit meant a lot, and then the shit changes, meaning the future just became not so important. What do I mean with that? If we look at Tesla as a company, they have a couple of things that are relevant right now. Excuse me. One is the deliveries of cars, and that translates into sales, and that translates into profits, and that translates into cash flow. So this is something that you have right now. So-called value investors look at this. Value investors look at a very, very short term, because that's how they value companies. So they basically implicitly say, we don't care about the future because we can't predict it, but we know what's to be expected today and maybe next year. And if that price that we're paying is relatively interesting to the opportunity cost, then we buy. That's what value investors do. So if you can buy a company for 4% dividend yield, and the treasury gives you 4%, then maybe you're just at the brink. But if you can buy the company at 5% dividend yield today, and the treasury gives you 4%, you're going to choose to buy the company because you expect next year to make another 5% and then another 5%. So cumulative, you make more money than if you bought the treasuries. That's the thinking process of a value investor. So it's very mechanical, and it's very, very much driven by the risk-free rate or the opportunity cost of capital. Now, the growth investor, or the investor in fundamentally new concepts and engineering practices, which is what we are, puts most of the value of the company into the future. That's what is the word shit in my title is referring to the future. So the future of the company means a lot, and that's why we're on top. And if the future starts not being that important anymore, well, then you're gonna lose value, and that's what happened. Now the question is, why did that happen? And it happens for several reasons, but the fundamental reason is, again, it's because you get immediate return through the risk-free rate, or in other words, you give the money to the government and they pay you a decent return. So you're not going to worry that much about the future. That's one. Second, there is this thing called the narrative in the market, which is, oh, the company is not doing so well, and so on and so forth. We can all summarize this in one word, which is competition. And this is Peter Thiel. Competition is for losers. 0 to 1 goes to extensive length to describe that the wealth-generating company, first and foremost, has to make sure not to be in competition. I think we investors sometimes forget how important competition is. When we analyze companies, we really only focus on two things. That's the mechanics of the stock market. It's competition and the opportunity cost of capital. Because the competition is going to define what your future dividends will be. What do I mean by that? Well, if you have a prospect for a company, let's say the Dutch East India Company has a monopoly on importing silk and spices from Indonesia to Europe. That's their business. If you think that they're going to keep that monopoly, that they will not have competition, then you can extrapolate whatever they're doing into the future, and you can assume that the market will grow, and therefore the profits of the Dutch East India Company will grow. But if you assume that for some reason that, and there is a part in my story where there's all of a sudden, because the prices of silk go up a lot, there is silk from China coming into the European market, and then silk through India coming into the European market from, let's say, maybe places like Afghanistan or whatever. In those days there was no Afghanistan, but you get my point. Like all of a sudden commodities, which those products are commodities, they start they start coming from different places because the price is so high. So competition is a very, very important factor in determining the future prospects of a company. So this, again, this is the most, so when we as hedge fund managers sit down and think and do our work, this is what we actually do. A successful hedge fund manager, at least in the equity side, so a hedge fund manager that invests in disruptive technologies, such as our fund, spends most of their time in thinking about competition. Why? Because we've already determined that the company is using fundamentally new concepts and engineering practices. This has been determined. So there is research and development, technological innovation, disruption, all of these things are happening. And we are disrupting several markets. In the case of Tesla, we're disrupting the transportation market. We're disrupting the driving of a car through self-driving. We're disrupting energy. We're disrupting solar. We're disrupting car insurance. So there's a lot of things that we're attacking. And the growth prospects are very good if we succeed from a technological perspective. But now we have to also decide how is this going to translate into profits. And that is a question that we can only answer through competition. In other words, what is the competition for Tesla? This is really what this comes down to. What is the competition for Tesla means where do we stand in terms of, let's say if we make 30% gross margins, well, others will want to have a piece of that. So we have to understand competition. And that's why Clayton Christensen is such an important factor in our work. It's because we really, really care about how this disruption is defined. The definition of disruption is that you don't have competition. And the reason you don't have competition is because the incumbents either don't care or they don't even know you exist. Now, our thesis at Orange Capital Partners is that the reason you don't have competition is not because people don't care. So we have kind of evolved Clayton Christensen's thesis here. What we're saying is that the reason a company like Tesla is going to disrupt other companies is because their cost structure is lower, and therefore the other companies cannot compete, because lowering their cost structure is very difficult. And this has been another reason why the stock sold off this year, because Tesla raised their prices, and therefore the chances for Tesla to be a real disruptive company with a lower cost structure have diminished. And it's up to Tesla to show that they can actually lower the cost structure. Basically, what we're looking for in the coming quarters by Tesla is the ability to lower price and keep margin, which in other words mean they can adapt their cost structure. Because that is the most important indicator for competitiveness. If Tesla can do that, that means they're competitive, and that means that the future prospects of the company will be successful. So to summarize, the mechanics of the stock market, the first principle approach to any kind of investment has to go through two vectors. One is competition, and the other is the opportunity cost of capital. Those are the two fundamental building blocks of any investment in a productive company. And there is, like we said, usually only one company per generation, if you're lucky you get two, that has the ability to generate wealth by investing in fundamentally new concepts and engineering practices. But the only way you can generate wealth is if competition is kept at bay. And Peter Thiel uses I think he calls it alpha times delta, which is the market size alpha, and delta is the share of that market that you can capture. Alpha times delta has to be high. You can have a very large market, but a very small share, or you can have a very large share of a very small market. Those are both valid investments too. Most of the stock market consists of either companies on this side or the other side, high delta or high alpha. But companies that have a high alpha and a high delta are those that generate the big wealth, the generational wealth. Tesla is one of those, we believe, because they have the engineering expertise and the ability to generate to generate products and services in large markets at lower cost. So in other words, we also believe that the delta, which is the share of that market, is going to be very high for Tesla. This is our thesis. This is what we believe in. This is why we are still invested in Tesla and why we're going to keep increasing our position in Tesla. But it also explains why this year the company has lost in value, because all of these factors got questioned. Again, the title of the essay that hasn't been finished yet, so I'm going to discuss it formally, but I'm viewing it now because it's the end of the year and I want to discuss what happened this year and so on and so forth. We lost money because the future of Tesla means less to investors, and that's for two reasons. One is because the opportunity cost of capital went up. In other words, you can find investments in government bonds that are lucrative, and therefore you don't have to worry that much about the future. But more importantly, also Tesla has shown that they can't control their cost structure as well as maybe we thought. They were a victim of inflation like everybody else. Now we believe that they can reverse that. We believe that there is deflation in the cost structure of Tesla. Therefore, we expect them to lower prices, and therefore we expect Tesla to become the competitive company that they've always been. If we're right about that, then there is absolutely no reason why Tesla should not become the most valuable company in the world, and therefore also give us maybe 8 to 12x in the next 3 to 5 years, which is of course a fantastic investment opportunity. Thank you.